All right, let's go ahead and get started then. Thank you very much for your help, Vicky and Maud and Adinda. Thank you. All right, hello everybody. This is Ilian Yotov. Thank you very much for joining us today to our third quarter of 2010 outlook for the major currencies. Let me start with a quick introduction to let you know who I am. For those of you who are not familiar with my name, I am the founder of allthingsforex.com and tradertape.com, a couple of popular financial websites. I'm also the host of a popular daily All Things Forex broadcast. You can listen to the program. It's available on fx3.com or on my website, allthingsforex.com. Many currency traders are familiar with my name because also I'm the creator of the quarters theory, which is a new foreign currencies trading method, very unique. And my book was published by John Wiley and Sons in January of 2010. So for those of you who are interested in finding out more about the book, more about the quarters theory, make sure to go to my website, allthingsforex.com. You can pick it up from there, or you can go to Amazon.com or any of your local Barnes & Noble and Borders bookstores and order it there. What we're going to do today is we're going to take a look at some of the trends that have been very strong trends in the second quarter of 2010 and find out what the third quarter may have in store for us. And the big question is, once as traders, of course, we've been able to distinguish trends and recognize them, is whether or not these trends will continue or reverse at some point. So, as we have now started the third quarter of 2010, I think one of the main questions that a lot of traders are asking themselves is, are we going to continue the trends that we saw in the second quarter into the new one as we are now seeing that quarter underway? What were the main trends for the second quarter of 2010? Many of you who trade currencies, there's no way you have missed them. You have seen a very strong bullish US dollar trend versus the euro, the pound, Japanese yen, and other major currencies persisting in a second quarter of 2010, pretty much for the first half of 2010. The problem is, however, that in recent weeks, especially in the month of June, which was the final month of the second quarter of 2010, we actually saw these trends coming to a halt. And the big question now is, will the US dollar maintain that strength that we saw in the first half of the year for the rest of the year in the second half? What I was saying earlier, and I wanted to give you a quick example of that. Some of those who think, well, the dollar is still in a positive bullish trend against the euro. That's, in the long run, that is true. But in the last month of trading, especially in the month of June, it's not very difficult for a trader to start recognizing some new developments that were beginning to emerge. And that was that at least the short-term direction of the trend for the US dollar versus the euro was beginning to reverse. A few weeks ago, if you take a look at this chart, in the beginning of June, we started seeing the euro actually finding support at what was a new 4-year low, a little bit below $1.19. To be exact, the number are actually $1.1876, if I'm not mistaken, was the exact low, 4-year low for the euro against the US dollar. The euro found support at that level. And we saw about 10 or 11 consecutive trading sessions of euro strengthening versus the US dollar. During that move, a high at the $1.2466 was established there in June 18 or June 21st, one of those 2 days. That level established itself as a new short-term resistance level from which the euro started pulling back, as you can see in the days after that. This is, by the way, a daily chart of the euro against the US dollar. We had that couple of weeks of a pullback or a week or so. And then very quickly, especially in the last 5 or 6 trading sessions, the euro began to rally again. Now, it doesn't take a rocket scientist when you take a look at a chart like this to find out that the direction in the last month of trading, pretty much from early June until recent days, the short-term trend direction for the euro-dollar pair has actually reversed from negative to positive. And that's the technically bullish development. And that is happening, very interestingly, right at the end of the previous quarter, and as we are about to begin the new quarter. And in the days, as you can see here, as soon as June, or rather July 1st began, we actually started seeing that breakout occurring above $24.66, which quickly opened the door for the euro-dollar pair to move higher and to approach some important resistance levels from the month of May. A couple of these resistance levels are $26.91 and then $27.38. If you paid attention to the euro-dollar exchange rate yesterday, we were targeting that $26.71 area, and we approached it very, very closely. So technically speaking, we're already beginning to see some things that are emerging, that are happening here, that are hinting to at least short-term reversals, and ultimately, if they continue, if that trend continues to persist, that could lead to much larger, longer, and midterm trend reversals. These short-term trend reversals, however, are within the context of other trends, which are the mid and the long-term trends, which are still obviously negative for the euro against the US dollar, and I'll show you the chart. But what we also, besides all of these technical developments that were happening in June and in recent days and weeks, one of the main questions now that is beginning to emerge, and especially in light of the stock market not being very, very strong, which is an environment that causes more risk aversion, which normally is an environment that actually ends up helping the US dollar as a safe haven currency, we actually saw the US dollar getting punished in a way in that kind of an environment. The US dollar, instead of rallying, when we get more risk aversion, when we get more weakness in equities, the US dollar actually was weakening. And the euro, as I showed you with that short-term chart of the euro versus the US dollar, actually was strengthening in that kind of an environment, which is not our usual relationship between risk aversion causing more US dollar strength and vice versa. So I think that a question that we need to also ask ourselves now that we're starting the new quarter is, will the US dollar get punished in a third quarter for the lack of fiscal austerity in the United States? And also, if I may add to that, for the Fed's lack of urgency to consider raising interest rates in the third quarter. Because in recent weeks, we also witnessed the Fed's renewed commitment to keep interest rates low for extended periods. These are a couple of very interesting questions that we need to find the answer to, and I'm sure that we will as the weeks and months ahead of us come in. So why I think that this is a valid question? Is the US dollar getting punished for the lack of fiscal austerity in the US? I already showed you what the euro's been doing against the US dollar. Well, we know that the governments in the eurozone are now embarking on some significant austerity, debt reduction, and spending cut measures. Interestingly enough, the government of Japan also recently announced some debt reduction measures and austerity measures as well in that country, and spending cuts along with that. Should it be a surprise then to see the Japanese yen also strengthening? Now, in periods of risk aversion, the Japanese yen is also considered as a safe haven currency. And when one compares the US dollar and the Japanese yen together, one against the other, it's also perceived that the Japanese yen is even safer haven than the US dollar. The reason is because the economy of Japan is mostly an exporting economy. Japan often, in most instances, runs a surplus, trade surplus. And that is one of the reasons why it's easier for Japan to finance its debt compared to the US economy, which is mainly an importing economy running trade deficits rather than trade surpluses, and the U.S. has to rely on outside funding to finance its debt. This is one of the reasons that has been also helping the Japanese yen in this risk-averse environment. But also, I think that another reason we can add to that is that the fact that recently the government of Japan also announced some fiscal austerity measures. Another country and region that announced fiscal austerity measures recently was the United Kingdom. Many of you would recall that a few weeks ago, we had this so-called emergency budget announced from the United Kingdom's government, which contained some significant spending cuts and debt reduction plans. This is called fiscal austerity, obviously, and the short-term chart of the pound against the US dollar looks quite similar to the euro-dollar chart, doesn't it? Is it any wonder that all three of these currencies whose governments are embarking on some and taking on some fiscal austerity measures are actually strengthening in the month of June against the US dollar? Here's what's happening with the euro against the US dollar right here in the recent weeks at the end of the second quarter and the beginning of the third quarter. Now, I showed you the short-term chart, and obviously we have a reversal there. A negative euro trend has turned into a positive euro trend on the short-term side of things. But that doesn't necessarily mean that the euro has reversed its negative midterm trend. Obviously, this is a weekly chart of the euro-dollar pair. A lot of traders use that as a guidance for the midterm trend developments. It is more than obvious what the direction of the euro's trend, as far as the midterm is concerned, is. However, because of the strengthening of the euro throughout the month of June versus the US dollar, we're now seeing a very interesting development, and in my opinion, this is a healthy price correction that is taking place for the euro versus the US dollar. We're witnessing here an opportunity for the euro to produce a more significant price correction on the midterm side of things. I also like to follow the Elliott wave theory, and in my book, The Quarters Theory, by the way, I give you some of the basics of what my version of the Elliott wave theory is, and I call it, for lack of a better term, the Quarters Theory trend wave. But it's based on Elliott wave, obviously. And very clearly here, you can see a sequence of several consecutive bearish trend waves. Bell is asking, what are the green and red lines? Think of them as a buying and selling pressure charts, since moving averages there. It's not exactly moving averages. It's a software that I've been involved in since 1999. In my opinion, this is the best trend evaluating software program in the industry, and I've been using it for many, many years. And it makes things very simple. I mean, the previous educator, you probably have seen the candlesticks and all that stuff. When I take a look at this, it takes you seconds to evaluate the trend. Besides that, so hopefully that explains the question about. You can see here that we have several consecutive bearish trend waves following each other, especially the most recent one, which started about in the month of April for the euro versus the US dollar, has taken the euro dollar exchange rate from as high as $1.3691, which was a high in April, to new 4-year lows for the euro-dollar exchange rate at the $1.1876. Now, this is a decline of almost 1,800 pips. 1,800 pips almost of a decline for the euro against the US dollar in just a few months. That's a rather significant decline. Now, as you can also see here, this particular bearish trend wave has been lasting for a number of weeks. That's 1, 2, 3, 4, 5, 6, 7, 8, 8.5, 9 weeks even. So, in a way, that bearish trend wave has also become overextended. And it's been long due for a price correction. Not only because the current bearish trend wave is being overextended, but also because the actual trend wave sequence, now consisting of multiple 3 or even 4 trend waves, because this chart goes back to February, but if you go even a couple of months after that, you'll see that the euro's been dropping pretty much as we discussed, by the way, in the beginning of the second quarter since the beginning of the year, when the euro started breaking down from the $1.50 level, or even above $1.51. So this is a multi-month type of a trend. Week after week, month after month, for the majority of that time frame in the first half of the year, we have seen the euro in a negative downtrend versus the US dollar. It's been long due for a more significant price correction. And perhaps that is exactly what we're witnessing now. Simply because that decline of the 1,800 pips for the euro against the US dollar during that overextended bearish trend wave, we had an attempt here to produce another consecutive bearish trend wave, but as I also explained in my book, The Quarters Theory, I explained the phenomenon which I call the trend wave failure. The bearish trend wave here, which was number 4 or 5, if I'm not mistaken, in order for it to be successful, it had to break below $1.1876. But that did not happen recently. If you recall, the euro-dollar pair managed to target a double bottom support from the month of May at $1.21.5. It approached that level recently, but it never broke below it. And that is why in the beginning of June, we actually saw a couple of attempts to break below $1.21.5. However, that area was not broken below, and we saw the euro only to strengthen in the weeks after that. So this caused a consecutive bearish trend wave failure, which, as I explained in my book, is the main consequence of trend wave failure, leads in most instances to a reversal trigger wave in the opposite direction of the previously established trend wave sequence. Well, in the case of the euro against the US dollar, we have a bearish trend wave sequence. So a reversal trigger, as I call them, reversal trigger bullish trend wave is logical to expect should the current bearish trend wave actually fail. And that is what we saw with that bearish trend wave. No break below $1.1876, finding support once again at double bottom support from May at $1.21.5, and then reversal trigger bullish trend wave on a midterm weekly chart of the euro-dollar pair in the opposite direction of the previously established trend. Short-term resistance at $1.2466, the resistance area around here gets broken above, and now we have a reversal trigger bullish trend wave, which is in its nature, by the way, a corrective bullish trend wave. It doesn't necessarily mean that that bullish wave that we're now seeing on the euro-dollar daily chart is going to reverse that strong long and midterm downward trend for the euro against the US dollar. But it does mean, in my opinion, that this bullish trend wave is now the cause as to why the euro is correcting, along with all of the fundamental factors. Perhaps that the US dollar got a little punished, if you will, for the lack of fiscal austerity in the United States. That couple of technical and fundamental factors there that may be supportive for the euro dollar to produce that larger price correction. Now, for a lot of traders, during these price corrections or reversal waves that are happening, which are corrective in their nature, it's not a bad idea, you would know from experience, to calculate the familiar Fibonacci retracement percentages in order for us to figure out approximately how far can this correction take us to. Now, we already said that the current bearish trend wave has taken the euro dollar from $1.3691 to a low at $1.1876, which is a decline of almost 1,800 pips. So if we get a little bit of a correction here, first, maybe even second bullish trend waves that are corrective in nature, obviously this could be a correction of the euro dollar's losses of at least 1,800 pips. Well, the 50% Fibonacci retracement is always the easiest to calculate, isn't it? So if we had the euro declining by 1,800 pips, can we actually anticipate that if the market decides to go with up to 50% Fibonacci retracement, then perhaps the euro dollar pair could correct at least 900 pips of its losses? That means that the euro could bounce off of the lows a little bit below $1.19 by 900 pips, which means that the euro dollar pair, if the market goes with a 50% correction, could actually approach $1.28 level, which would be approximately the exact 50% retracement of this bearish trend wave on the midterm weekly chart of the euro-dollar pair. So I don't think that it's illogical for a trader to have these kind of thoughts, right? So what we have seen now is about the 38.2% Fibonacci retracement area being challenged, especially the previous highs with the area that I told you. And let me quickly switch here and go to the live chart so I can show you what we're talking about with some actual price points here in live market environment, if you will. Hold on one second. I'll minimize this, bring you to this here. All right, here's that bearish trend wave. Here's the corrective bullish trend wave that is ending an overextended bearish trend wave, overextended bearish trend wave sequence for the euro-dollar pair, providing an opportunity for the euro-dollar to correct. Here you can see a couple of price points that may be significant for the euro-dollar retracement, and these price points were $1.2738 and $1.2671. So we have $1.2671, we have $1.2671 here, we have $1.2684, and we also had $1.2738. Those are several price points that I'm focusing on here during this price correction, because we said up to 50% Fibonacci retracement of the euro against the US dollar could see prices go up to $1.28. But before $1.28, we may have an important resistance area of about 50, 60 pips between $1.2681, $1.2671, and $1.2738. $1.2738, by the way, also coincides with being a close price point to a very important price level in my quarter scale, which is the $1.2750 large quarter point. So, if the euro obviously continues to strengthen here, and here's the short-term daily chart of the euro-dollar pair. It's been going up for about 5 days now. It seems like it may be losing a little bit of a steam here. This is the most recent price point on the chart where things are happening today. But obviously, if that bullish trend continues, and the euro may have a little bit of legs to go, if you will, to at least challenge $1.2684 or 71. If you recall, $1.2662 was the intraday high from yesterday. Just take a look at the high there. So we're not very far from that first resistance level from May. And then if that level is broken, then we could see the euro-dollar exchange rate quickly moving to $1.2738, which is only 12 pips away from the large quarter point at the $1.2750. And then if a break above that area occurs, I wouldn't be surprised if the euro-dollar pair goes to $1.28 and then ultimately maybe even to $1.30. Now this is on the short-term side of things, so we can anticipate. In the long run, however, we also said that once this price correction is over with, whether it's one or two corrective bullish trend waves, then ultimately they may not be strong enough to reverse that negative downtrend for the euro against the US dollar. And after this correction here is over with, we can still anticipate that the euro negative trend will continue to decline. Now, that's the million-dollar question, is it not? But also what's very important for us, currency traders, is to find out the answer to these other couple of questions. Should we expect more risk aversion and further safe haven currency strength in the third quarter of 2010, which ultimately means more strength for the US dollar, the Japanese yen, and the Swiss franc? And what could provide the clues for things to come in the third quarter? Because technically we're already seeing what's happening. I don't have time today to take a look at other currency majors and other currency pairs. So that's why we're focused on the euro against the US dollar as the most popular currency pair. But what could provide the clues for things to come in the third quarter? We looked at the technical developments, and in my opinion, what we also need to find out and pay attention to are several major fundamental factors that, in my opinion, are going to continue to drive the trends for the major currencies in a third quarter. What are the factors that will drive these major trends in a third quarter? Well, I found at least 7 factors that we all need to watch in a third quarter of 2010 that will give us the answer as to whether or not the price correction, for example, of the euro against the US dollar is coming to an end, and whether previous trends of US dollar strength versus the euro are going to continue even further in the third quarter of 2010. The first factor is the sovereign debt crisis. As many of you know, there are still a lot of unknowns. What we know right now is that there's still a lot of unknowns when it comes to the Eurozone debt crisis, how this whole thing is going to play out, and obviously it spread around the world, not only in a Eurozone. Investors, in my opinion, still do not seem very convinced that the worst is behind. Recent studies, for example, show about 70% of investors still believe that Greece is going to default on their debt. That is despite of the massive $1 trillion worth, 750 billion euros worth of financial support that was provided from the European Union, the International Monetary Fund, and also the US Treasury. The second factor that we need to pay attention to, and all of these factors, by the way, are closely related to investor sentiment, risk appetite, and sentiment, etc., that will obviously impact the major currencies, and not only the major currencies, but also the financial markets worldwide. In the recent several weeks, especially throughout the month of June, we have seen more and more signs of a worldwide economic slowdown. This is the kind of an environment where the markets realize that the worldwide economy is slowing down, which obviously could cause more weakness in equities. And as I showed you earlier, the yen, even the yen has strengthened not only against other majors, but against the US dollar as well. It has gained, the Japanese yen, about 13% against its global peers just in 2010. 13% of a gain for the yen against other majors. That is according to recent studies, and that is all because of concerns that the global economic recovery is slowing down. Now, we have seen in recent weeks that all of these nations in the Eurozone, the United Kingdom, Japan, are announcing some measures to reduce budget deficits. According to JP Morgan Chase and Company economists, the rich nations of the world are going to reduce their primary budget deficits, excluding interest payments, by 1.6 percentage points next year. So this is not that bad. However, the budget squeeze and debt reduction measures and spending cuts will take about 1 percentage point off of the economic growth in 2011, obviously leading to a slowdown in a worldwide economic recovery. Strategists at major financial institutions are now also warning that given the world's major economies may struggle to maintain their forward impetus of their economic growth because of the stimulus, fiscal, and monetary is set on a path towards normalization. Early signs of the loss of momentum in worldwide economic growth are of concern, according to a lot of experts. And I think that is a factor that we need to watch. Given that many deficit reduction programs across the industrial world are still early announced, they're going to be implemented more aggressively in the months to come. I think that this momentum that we're starting to lose here could actually once again cause an environment where we get to see more weakness in equities, more reduction in risk appetite, and ultimately leading to strengthening of the safe haven currencies, if that is the case. This could be obviously one of the reasons fundamentally that ends up the euro's recent strengthening versus the US dollar and causes a resumption of the single currency's downtrend versus the dollar, and ultimately the dollar strengthening against other majors as well. The third factor that I find was going to be very important in the third quarter is fiscal austerity. Will the markets continue to reward fiscal austerity as we have witnessed in the month of June? Or will the market participants actually realize that the austerity may pose serious threat to prosperity and economic growth. That all of these austerity measures are ultimately going to lead to a worldwide economic slowdown, or at least a slowdown in these economies whose governments are taking on fiscal austerity measures, which ultimately could impact their currencies as well. Another factor that we'll pay close attention to in the third quarter is interest rates. As currency traders, we know that yield differentials and interest rate differentials are some of the main drivers of currency strength. Will central banks around the world continue to keep rates low in the third quarter? As I mentioned earlier, we had the Fed already committed to keeping interest rates low. Obviously, they're not in any hurry to start raising rates. I don't think that the European Central Bank is in a position in the midst of a debt crisis in the Eurozone to start raising rates anytime soon. I don't think that we also are going to have the Bank of England in position to raise interest rates. And we had recently some central banks like the Bank of Canada, the Reserve Bank of Australia started it all, Bank of Canada started raising rates, Reserve Bank of New Zealand started raising rates as well. Those currencies are also the higher yielding commodity currencies. And they can only strengthen in an environment that is supportive to risk. According to some experts, the recoveries worldwide are very slow, and any tightening of monetary policies by central banks will cause a big problem. Therefore, I'm not seeing these major central banks like the Fed, the Bank of England, the European Central Bank raising rates, at least not in the third quarter. And maybe not according to the latest futures estimates. Futures traders are now, if you recall, just months ago, the Fed was expected to raise interest rates by the end of 2010, even in a third quarter that we just started of 2010. Now these expectations are obviously changing, and the latest futures data, interest rate futures, are actually showing traders pricing in a probability of the Fed not to raise interest rates even until the second quarter of 2011. According to Deutsche Bank, they call this a, quote, new market regime. The dollar's decline against the euro and the Japanese yen in recent weeks in the face of a falling stock market, something that normally, as I said earlier, causes the dollar to actually strengthen, not to weaken. According to Deutsche Bank strategists, the dollar's drop against the euro and the yen in recent weeks in the face of falling stock market signals more weakness as investors reduce bets on the rate increases by the Federal Reserve in the U.S. The dollar continues to weaken. Strategists at Deutsche Bank said the dollar continues to weaken despite of stock weakness, which suggests, quote, a new market regime. Are we in for a new market regime in the third quarter of 2010, especially because of the lack of urgency from the Fed here in the U.S. to raise interest rates? That could be a major threat if such new market regime is actually established in the third quarter for future U.S. dollar strengthening. Deutsche Bank warns that this fits their view on the Japanese yen outperforming the U.S. dollar if the Fed remains on hold for the foreseeable future, which the market is increasingly pricing in. And the quote, if the market continues to price that in, could the U.S. dollar continue to suffer in the third quarter? Another major factor would be the European Union bank stress test. Now, this is coming up in the next several weeks, and I think we should pay very, very close attention to that, especially if you are concerned about what is next for the euro against the US dollar. European Union leaders pledged on June 17th to disclose the results of the stress test in the European Union banking institutions by the end of July. The French finance minister last weekend said that the results of the bank stress test will be published on July 23rd. I'm not sure if that's going to be just the banks from France or the banks from the entire European Union. So why are the stress tests so important? They're needed obviously to rebuild investors' confidence. Also, they're important because more transparency obviously could help investors' confidence. If you recall, with the United States stress test, they led to improvement in investors' confidence. Once it became apparent and visible to investors as to what the situation of the financial system and these banking institutions was, how many bad assets they had on their books, etc., etc., how many they wrote down, how many new new losses they had to take and write off. So the U.S. stress tests in general were actually a success, and the reason why they were a success is also given to us by the market's reaction that happened in second quarter of 2009, when the markets found the bottom in March, and then we saw 9 months of a equity strengthening and rally. One of the other reasons as to why the stress tests are going to be important from the Eurozone is because the European banking system is the largest in the world. It has a total on-balance sheet assets of 31.1 trillion euros. That was at least the assets they had at the end of 2009. That makes the Europe banking system more than 3.5 times the size of the United States banking system. So obviously these stress tests will have a major impact. Now, the U.S. government bank stress tests were a success, but there's a lot of concern that the European stress tests that we're about to see in the next few weeks may not be as successful. The region's banks have written down a proportionally lower percentage of their assets compared to the U.S. counterparts. As of latest data from the International Monetary Fund will show 7% of U.S. banks' assets have been written down by the end of 2010, where the euro area banks have written down only 3% as of yet. These European banks have not shown analysts and economists and investors around the world that they have completed their write-downs. Unlike the U.S. government, the European Union governments haven't really said that they will provide the cash necessary for the banks that fail the stress test. And that's a big concern as well, because if the governments in the Eurozone are not able to shoulder their sovereign debt, and then on top of that, if they have to bail out financial institutions, some of them might need to bail out half of their financial system on top of that, then where are they going to get the money to do all of that? Obviously, major concern, and we'll definitely pay close attention to these stress tests in a few weeks from now. Another major factor will be the U.S. and G7 corporate earnings in the beginning of each quarter. As you know, it's earnings season when it comes to corporations, and these earnings seasons can really impact how equities are traded around the world. If the earnings season obviously is good, then the equities could strengthen. That could be positive for risk. We could see more investors, sentiment improvement, and ultimately leading to more investors willing to take on additional risk. But if the corporate earnings in the U.S. and the G7 countries are a disappointment, and if we get to see okay earnings and maybe guidance that is a little bit more conservative for the upcoming quarters, hinting again to possible slowdown to come in the future, then obviously that could have a negative impact on investor sentiment. Last but not least, foreign exchange reserves diversification trends. This is a very, very important factor to watch, because foreign exchange reserves diversification for the euro, for example, has been the backbone, one of the backbones of euro strength throughout the last decade, as many foreign exchange reserves managers were diversifying their US dollar holdings into the second best alternative, which was the euro at that time. But because of the Eurozone sovereign debt crisis, now the euro is starting to lose its appeal as a alternative to the US dollar as a reserve currency. And if that continues to be the kind of trend that we see going forward, then obviously it could have negative impact on the euro. Reserve diversification, central banks are now putting more of their reserves into currencies other than the euro. That is according to data from the International Monetary Fund. Reserve diversification, one of the drivers behind euro strength ever since the introduction of the euro. is unlikely to be the euro-dollar supportive over the next few years, according to some current estimates from economists at major financial institutions. On the other hand, however, these foreign exchange reserve diversification trends that may not be very positive for the euro are actually starting to favor some of the familiar to us commodity currencies. Commodity currencies diversification is now underway, and that's an important trend to pay attention to. The proportions of euros and dollars in a global foreign exchange reserve are both falling, according to latest statistics, in the first quarter of 2010, as central banks are increasing holdings of currencies from other economies. What are the other economies and these other currencies? Well, the share of other currencies is including Canadian dollars, Australian dollars, and Norwegian krone. All three of these currencies are also commodity currencies. Shares of Canadian dollars, Australian dollars, and Norwegian krone in foreign exchange reserves is now rising 3.7%, the highest level in at least a decade, according to the International Monetary Fund. So that's a very important, those are very important 7 factors to watch in the third quarter of 2010. I'd like to thank you for your time. We're running out of time for this webinar today. Thank you very much for joining me. And if you like to listen to our daily analysis for the currency market, you can do so by listening to my All Things Forex live daily broadcast every day, Monday through Friday, 1 to 2 p.m. Eastern Time. And you can listen on our website, allthingsforex.com, or you can also find it on fx3.com. Thank you all very much for attending. Have a great afternoon and happy trading.